Are you in control of your debt, or is it in control of you? We're about to share with you a way to eliminate your debt quickly. Sit back and get a pen and paper to write down any questions you may have. Once the video is complete, you can view a demo of the live software by simply clicking on the demo icon to the right. Let's dive right in. I'm sure you've heard of companies like Microsoft, Apple, eBay, and Starbucks. Their founders were awarded the Ernst & Young Entrepreneur of the Year award when they first started, which is a highly credible award. They were seen as being a company having a viable product or service that would have an impact on our society. Recently, the creators of the Advanced Interest Minimizer received the same award in the financial services category for the Utah region. To put that into perspective, Ernst & Young is one of the top 3 accounting, tax assurance, and financial firms in the world. We've been acknowledged by several publications, including True Wealth, Mortgage Planner, Success Magazine, and we received the Editor's Choice Award for 2008 from Personal Real Estate Investor. To explain what the Advanced Interest Minimizer is, let me first tell you what it is not. It is not a bi-weekly mortgage program. It is not a debt roll-down program. It is not just a concept or theory, but most importantly, this program does not upset your budget.
We have 4 key money-saving principles. The first one is strategic payoff. The second one is interest accumulation. The third key principle is interest float. And the fourth is interest cancellation. Here's what an amortization schedule looks like on a 30-year, $200,000 loan at 6% with a payment of $1199.10. If this client makes their payment as scheduled, at year 21 we can see they have gained half of their equity, yet they have paid more than they borrowed. So at the end of 30 years they will have paid more than double the amount they borrowed. In other words, $431,000 on a $200,000 loan. Banks hold depositors' money as long as they can to leverage themselves. They wait until the last minute before dispersing funds to various accounts so they can, in the long run, hold on to every cent. This is how they continue to make profits. Now it's your turn to have a system that does the calculations for you, allowing you to use your banking systems to bank like a bank. Did you know that if you pay your mortgage on the 1st, when the bank asks for your payment, the bank will hold on to that money, gaining interest on it daily for 14 days, and apply that payment on the 15th? What if you let that same money work for you those 14 days? It's called time value of money. Our program has 24 pages of math algorithms working for you. That means that your software is tailor-fitted to your specific financial situation using existing banking tools at your bank. We just offer the software and education to get you out of debt the fastest way possible based on your unique situation. Let's discuss the first of the 4 money-saving principles, strategic payoff. Think about this. In what order would you pay one debt? Well, there's really only one way to pay it. What if you had 2 debts? You had a car loan over here. Which one would you pay off first? Well, you could pay the mortgage and then the auto loan, or you could pay the auto loan and then the mortgage. So there's 2 possible orders to paying those debts off. What if you had 3 debts? 3 debts, there'd be 6 different ways to pay that off. If you had 4 debts, there'd be 24 ways to pay that off. 5 debts? With 5 debts, you would actually have 120 different ways each month to get to the fastest way to zero. And only one of them, one of the 120, is the correct and fastest way. Finding the right order for the quickest payoff to zero involves precise calculations, not opinions. Factorial math simply calculates how many factors are in each equation. If you have 7 debts, that means you have a possibility of 5,040 combinations to guess which one gets you to zero faster and save you the greatest amount of interest. It is impossible to figure that out each month on your own. Why? Because this is recalculated each month when you have a change in the amount owed, interest rates, the ratio of principal applied versus interest paid, and many other determining factors. Fortunately, this software will factor all the correct math for you. Let me introduce you to John and Rebecca Jones. John and Rebecca make $5,000 per month net or after taxes, and they spend a combined $4,800 per month on all of their debts, expenses, and entertainment. This means John and Rebecca only have $200 left over at the end of the month. Do you need $200? No. You just need to spend less than you make, and we can show you as little as $1 left over will work. Here are their liabilities. John and Rebecca have direct deposit with the companies they work for, so their paychecks go into their checking account. The software prompts them to transfer that $5,000 from checking into savings. Now they have $5,000 in savings. So for the sake of demonstration purposes, realizing that everyone's situation is different, we are going to say that John and Rebecca can pay all their bills on their credit card or line of credit. We realize that the software will be customized for you and that your financial situation will be different from John and Rebecca. We are just keeping this simple so that you can understand the gist of how our program works. So they pay for their food, gas, and all of their household expenses, including all the bills shown here. Because their living expenses are $4,800, this means that they now owe $4,800 on that credit card or line of credit. The software now takes that debt into consideration and will address it the following month. You will notice that the debt amounts have changed because they continue to make their regular minimum payments as scheduled. So in month 2, their savings account paid John and Rebecca $12 in interest. Now they have $5,012 in their savings account. This is the second money-saving principle, interest accumulation. The software prompts them to take $37.89 from savings and transfer it into their checking account. After that, the software prompts them to take $4,800 and pay that credit card down to zero. We used someone else's money for 30 days and paid them no interest and allowed our money to work for us at the same time. This is the third money-saving principle, interest float. It then prompts them to take $39.89 from their checking account and pay towards their primary mortgage. And realizing that they still have money in their savings account, the software also prompts them to transfer $723 out of the savings into the auto loan. So this is what month 3 looks like. We now owe less on the mortgage and less on the auto. And this is what happened to the mortgage. Their new balance is $195,812. Their interest rate and payment stayed the same, but they canceled 18 months worth of payments and saved $18,746 in interest. This is the fourth money-saving principle, interest cancellation. What does this mean to you? If these were your numbers, you could now pay yourself what you would have been paying the bank, because you would not have to pay those additional 18 months at the end of the mortgage. You can see how powerful this is. Can you do this on your own? Perhaps with many hours of strategizing, overanalyzing, calculating, and constantly updating, and providing you're a math genius. But this program will calculate each strategic move for your money, making sure the timing is perfect and that each penny you have is working for you. The software will do many of these strategic maneuvers throughout the life of the program. So let's recap. Here is John and Rebecca Jones. They are 40 years old. On the conventional side, they will be paying on their debt until they are 70 years old. That is 5 years after retirement. With the Money Merge account system, they will be debt-free at 55 years old. That's 10 years prior to retirement, and they can pay themselves instead of their creditors. Plus, they saved over $120,000 in interest. It is important to understand the financial implications of holding on to debt. Holding on to debt will always cost you more money than you can earn on your own. As a society, we are emotionally involved in thinking that making more money is our answer. Yet it is our debt that in reality holds us back from achieving our financial goals. Sometimes people say, I can do this on my own. So let's look at what would happen if John and Rebecca sent their $200 discretionary each month to their mortgage. First of all, that is not what the Money Merge account does. Second, we know that most people will only do this for a short period of time because, well, life happens. However, if they did send in the money, they would not have access to those funds and it would only eliminate $73,000 in interest. The Money Merge account program saves you over $120,000 in interest without having to send over that $200 every month. Remember, if they were to use this option, John and Rebecca are not even addressing their other debts. You might be doing something to eliminate your debt, or you may be doing nothing. Either way, we have something here that will get you out of debt faster than any traditional method, book, CD, DVD, or class will ever teach you. No more calculating your debt, interest rates, and guessing which combination is going to save you the most money and time. because our system is personalized with your information. The system is doing the calculations for you, and you have a written, easy-to-use plan that is in line with your goal of getting to the fastest way to zero. If life throws you a financial curveball, the system adjusts the plan and gets you back to the destination of zero, and it's guaranteed. Our software helps you clearly see what your financial choices really do to your overall financial picture before you make that decision. If you decide to do an addition to your home, buy a boat, or whatever, the software will show you the impact, recalculating the years to pay off and the amount of interest you will pay. This is so much more than just paying off your debt. The visual representation of the Money Merge account system showing you when you will be debt-free is what we like to refer to as the financial GPS. It not only guides you to pay off debts, it helps you stay focused. Just like with a New Year's resolution, we often lack the discipline to follow through to the very end. It helps you to track success. The Money Merge account program doesn't just provide you with a one-shot analysis of your situation, but it directs you, even if you make a few wrong turns. It helps you to save for retirement. For example, let's assume you had this 30-year mortgage at $11.99 per month and paid that debt off in 15 years like John and Rebecca Jones. What if you kept paying that $11.99 to yourself or to an IRA for the remaining 15 years? We guarantee everything to the month and year you will be at zero, and to the penny on what you will save, in writing. All we ask is that you follow the software's prompts, and you will achieve the guaranteed savings as stated in your free analysis report. Many clients are ahead of the analysis because it is a conservative projection, and you will begin to see the effect of your financial decisions. We would rather underpromise and overdeliver. It is one of the reasons our company is always working to improve our product and get you those improvements at no additional cost.
Within the first 2 years of releasing the product to the public, the Advanced Interest Minimizer has helped clients pay down over $153 million in debt. Nationwide Biweekly Administration is on a mission. We want everyone in America to gain financial freedom. There is an additional video to the right that will demonstrate the live software. After viewing the software demo, the next step is to sit down with your representative and run your free analysis. This is a free service. All we need is the math behind the debts. No account numbers, no social security numbers, and no credit checks. Thank you for your interest in the Advanced Interest Minimizer program. We hope you'll take advantage of this incredibly powerful tool to financial freedom.